Hello everyone, I'm Dr. Stock, and in this video we're talking about GDP. Yeah, you know me. Because the International Monetary Fund just came out with their projection for the US for GDP for 2023 and 2024, and I have a few notes that I would like to talk about across the Fed GDP Now tool, and then also what we got from the SEP from the Fed back in March. Those are things that I think are going to be interesting to look at on top of the spreadsheet that I put out several weeks ago on my Patreon. That link for the Patreon is down in the description if you want to check it out. So with that said, I do want to get right into it. So let's transition over. So GDP, we get the advanced estimate for GDP Thursday, April 27th at 8:30 a.m. That's a significant date, so make sure that you check that out. The forecast as per Trading Economics, which is where I get this, is 2.9%. However, if we go over to GDP Now, we can see on this page, there we go, latest estimate, 2.2% is what we're coming in at as of April 10th. So that's Monday of this week that we got that. And that was earlier 3.2%, 3.5%, now down to 2.2% for the first quarter of 2023. So that's a big jump down from what we've seen. We've had downward revisions for the last quarter of 2022 and finally settling in at 2.6% as of our last read, as of the third estimate. So that's something to pay attention to there. So going back from that, the summary of economic projections they had for 2023 from negative 0.2 to finish up the year to 1.3% GDP to finish up the year. And that was actually an increase on the top end and the bottom end by 0.3 each for GDP. So, hey, stronger year. Let's go ahead and look at that. Well, then we have the World Economic Outlook coming to us from, it's at the top of this thing. Here we go. The International Monetary Fund coming out today. And you can check this out on their site. Just search IMF. World Economic Outlook, and you will find it along with these beautiful charts that are on here. Matter of fact, this one's nice and pretty. You can see the United States on this one coming in at 1.6% for 2023. There's the 2.1% that 2022 settled on. And then look, an even weaker, a more meager 1.1% for 2024. So not necessarily great for us. Check out emerging markets and developing Asia. They have 4.4 or 5.3, but I guess that's easier for less mature markets. So that's why they are called emerging markets. So let me jump out of this. And I'm going to go here so that you can also see the table that they have. And this is pretty cool because if you search for whatever area it is that you're looking for, you just start typing it. I didn't even get as far as typing United States, United Kingdom, United Arab Emirates. I want to focus on the US for this one. So that 1.6% is the thing that I want to look at and see what that looks like. So I want to switch from here over to the spreadsheet that I made. Like I said, it's available over at my Patreon. As a matter of fact, this is an updated one that I'm going to be putting over there very soon when you take a look at this. So I would do want to go through a little bit and tell you a little bit about what we're seeing. So up here in white at the top of this, we have 2021 all the way through 2022 for Q4. This is all historical information that we have here. And so the only thing that it might be missing would be any small revisions that we would have had since I made this one back in March. So that's something to pay attention to. Now I have updated the Fed's GDP now. Now it says 0.6, whereas they said 2.2. Where does that come from? Well, I don't know if you can see the formula or not, but it's up here. It's the 2.2%, and that's an annualized quarterly figures. So what they do is they take what they think it is. As a matter of fact, here I'll expand this decimal for you. You can see it's not exactly 0.6, it's actually 0.55, and when you multiply that by 4, that's where you get that 2.2 from. So more directly, they have 2.2. They put an equal sign in for it, equals 2.2, and then they divide that by 4, and it takes you back to their quarterly estimate that they have. So that's where I'm getting the 0.55% from. So just so that we know where that calculation is coming from. And so from the summary of economic projections, the median estimate came out at 0.4. So when you look at that, look what it does to our quarterly values. That's no growth, no growth, no growth on a quarter over quarter basis. That means quarter 2, quarter 3, quarter 4. If we're going to land at the Fed's median, there's no growth to be had whatsoever. If we land at the low estimate that we have here, for the SEP, that negative 0.2% that they said, that's 3 straight quarters. And now, mind you, these are linearized. In other words, that they're evenly spaced And that's not really what happens with a recession. As a matter of fact, if you take a look at the charts for that, if you go to St. Louis Fred and take a look at GDP, real GDP, seasonally adjusted for that, you'll see it's a very steep drop off, usually right at the beginning, and then it starts to slow down and turn. So we'll have to see what that looks like. Most likely not linear. What that means for these zeros, though, this is huge when we talk about these zeros that you see, because most likely we would dip first before coming back up, or maybe we would be up a little bit and then trail off later on. So just be aware of that it doesn't happen in a linear manner. I just did that to show in an average sense what that would look like. So you can think about these, if you're a math person out there, as secant lines rather than tangent lines or instantaneous values that we're looking at. So lots of contraction we had if we come in at the Fed's low estimate to end the year at negative 0.2%. And then for some of economic projections at their high end, the highest any of the voting members of the Fed saw was 1.3%, which is very slow growth quarter over quarter, following that 0.6% that we might get according to the Fed now, the Fed GDP now that we have. So that's something also to look at, to see that sort of slow-ish growth that we have. Doesn't mean we go negative first and then pop up and go more strongly positive. Doesn't mean that we start off strong and then taper off throughout the end of the year, in other words, to meet that target. Now, I did notice one of my formatting errors. It's driving me crazy. It's driving you guys crazy. Yellow, white, yellow. This bottom one should have a white background on it. So I'm sorry if you guys aren't particular about that. It'll take just a moment. There we go. It looks so much nicer. So now this is different because the SEP, we have the median, we have the low estimate, we have the high estimate. This last one is IMF's. As a matter of fact, if you read through, and I didn't get a chance to read through all 100 or so pages, 200 pages, there's a lot of tables and stuff and appendices at the end of it, so it's not a full 200 pages as it might happen to reflect. However, they say that they're not estimates. I forget the word that they use when they talk about it, but they say that they are working numbers, just placeholders for them to work with right now as they go and talk through what they're seeing. They said for the U.S., 1.6%, which is stronger than anything that the Fed came out with. And that actually shows us growth pretty much to what we had during the first quarter. So instead of coming in at 0.6, we're coming in at 0.5. And so a little bit of a slowdown from what we had in the first quarter. That's what the IMF is seeing right now. Now, mind you, this is all for 2023. Every one of these is just a repeat. Quarter one through quarter four, 2023. I didn't even get to 2024 yet. Now, mind you, that's not a big stretch from where we're at, so that if they say to go down to 1.1% for that, that's also something else that I could go ahead and work out from here forward. But I do want to get those advance estimates that we get on April the 27th before I go and do that. So with the IMF's estimate that we have, leading us to 1.6, linearizing these growth values to 0.5, we could see some strength for some of the quarters. We could see more weakness, but the 1.6 actually, it wouldn't be too terrible for us. I am just curious to see what this comes out to. Okay, so 0.48, so just under 0.5. But for estimates, 0.5, that 0.1% that we're looking at is good enough as we look through that. So it's interesting to see what the Fed has to say for their summer of economic projections, and that they have growth as muted as they do versus the IMF's estimate that they have for the world economic outlook. So while I have you guys here, I'm about to switch over to Moomoo. And check this out, I have an offer for Moomoo. It's the trading app that you see in my videos, and you can get up to 15 free stocks by using the link that's down in the description. So you can sign up, deposit your money, $100 or more. What that gets you is 5 free stocks and the free premium courses. So if you're looking ways to maximize your earning potential or up your stock market game, this is a really nice way to do that. The courses are quick, clean, easy to follow. They have video tutorials. They have ones where you can read through. It really is worth your time. And then also for $1,000 deposit or more, 15 free stocks along with those free premium courses. And maybe you noticed there was a $1,500 cash voucher available. That's through this financial literacy and U.S. paper trading competition that they have here. So you can do what's called paper trading, where they give you $100,000 in virtual cash, and you use that to trade pretty much however you would like to in the stock market and try to beat the other investors, the other traders that are out there throughout the month of April. And you can win up to $1,500 in your trading account, and you also get 1 month of Benzinga Pro free. So check that out. All right, that's enough of that. I do want to move over Moomoo itself. So here we go. We're looking at Moomoo and we're looking at the SPY. And today Today we closed at 409.72. So right now, this sideways trading that you're seeing, this is all that whole, are we going to see recession? Are we not seeing recession? Everything's looking pretty good. Inflation is sort of moderating. Now, mind you, we have the CPI report tomorrow. If you haven't watched my video on CPI, please go ahead and do so. I expect it to be pretty moderate, just in case that wasn't clear in my video as we watch it. And also inflation, I think by June's reports that we see significantly different information in a favorable manner. So to the downside for inflation by the time we get to June, certainly by CPI for all items headline numbers. Like I said, you can watch that video for more information. So I think the inflation reports are going to help us out, but also Q1 earnings are definitely something to watch. They're going to shed a lot of light on what is going to happen with GDP. So Friday, make sure that you're watching those bank earnings as they come out. I'm going to be watching for BlackRock is there, JP Morgan, Wells Fargo, Citigroup, and just a whole bunch of others. And that's a nice thing about Moomoo is that they give you the earnings calendars. They give you the stock screeners. You can see I have the RSI here, which is a momentum indicator. And right now we're in bullish territory, so that's a good thing. You can also put up, I know StockMo likes the Bollinger Bands. I tend to like the Bollinger Bands too, especially when you get a squeeze with the Bollinger Bands, because then you know a breakout's about to happen soon. And for those of you people out there who like to rely on low implied volatility and options and are looking for when that implied volatility spike is going to happen, holy crap, it's there. And they just have. It's so clean, easy, and whatever technical analysis you do in the computer, and this isn't trying to sell you guys, do what you're going to do. I hope that you do choose my link. It supports you. It supports me. It's a win-win for everybody. But I do have to say that the charts are clean, easy. That app is smooth, and it's integrated across platforms. So whatever TA I do here, so whatever drawings I put on, so they really do go across platforms. So if I put this on here as a line of resistance, and I put on another line for support. Let's go down here to this bottom where we keep on tagging and moving back up. That will show up when I open up the app on my phone as well, so I can keep on tracking where the charts are going throughout the day on my mobile device, as well as when I do the big heavy lifting on my desktop computer. So I do want to move on from there. We'll just take a quick look at the cues. And like I said, I can't stress enough how important it is for those earnings come out and give us more light on what exactly is going to happen with GDP. So I really am excited not only to hear what they have to say, to see, hey, can this bull run continue, or is it going to be one of those things where I'm glad I took out my short hedge? That's really what I want to know. So that's exactly what I'm looking for. That's what, in my opinion, why we're seeing the sideways trading that we are now. And time's going to tell what we see moving forward from here. I am keeping an eye on inflation, GDP, what the Fed is doing with their rate hikes. So what's the state of the economy? What are the consumers saying? I can tell you on the side of inflation, there's a lot of consumers, people who are not in the stock market, don't really do a lot with finance itself. They're just tired. They're tired of all the high prices. They're tired of paying at the gas pump. They're tired of spending the money at the grocery stores. They're tired of seeing the higher prices online when they shop for things. They're tired of seeing high prices in the stores. That psychology, that anecdotal information, it is meaningful because consumers for US GDP make up almost 70% of GDP. And I don't know, it doesn't matter, in my opinion, if you're high income or not. There's a lot of wealthy people that I know that are very frugal people. That's why they're wealthy. That's why they sit on the cash that they do, is because they don't just go out and spend it all the time. So even though that savings might be there, and even though that passive income might be there, they're unwilling to spend that money and part with it and be just part of the high inflationary situation. And, get a little bit stingy. And what happens when you tighten up the purse strings? You're not spending and it's not helping the economy, and then there's some slowdown. So we'll see if that anecdotal information keeps bleeding through into the reports. Is recession on the horizon? That's exactly the big question that we're all holding our breath for in the markets. Thank you guys for watching this video. If you like my commentary and like to hear more, check out the link for my Patreon down in the description. Click sign up and get access to my Patreon exclusives and be a member of my private Discord community and chat with me and my community members. We'd absolutely love to have you over there. Also, do not forget about that Moomoo link. It's an app that there's just so much depth to it, and it just offers so many incredible features and tools to help get your trading game to the next level. Honestly, trust me, it's worth your time to check out. And Just by making the deposit, you're also given 5 to 15 free stocks depending on your level of deposit, $100 or more or $1,000 or more. So thank you guys. Hit that like button if you like this video. Hit the subscribe button to see anytime that my videos come out, and ring that notification bell to be notified as they're posted. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.